Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about VALMONT Industries INC quarterly report. VALMONT Industries Inc. offers a diverse range of businesses and services across two primary segments, infrastructure and agriculture. The company's infrastructure segment includes steel and pre-stressed concrete products for electrical transmission, substation and distribution applications, composite structures for electrical transmission and distribution applications, metal, steel, wood, aluminum, and composite poles and structures for lighting and transportation applications. In addition to these products, the company provides various services such as galvanizing, anodizing, painting and powder coating towers, small cell structures, camouflage concealment solutions, and passive intermodulation mitigation equipment for wireless communication. Markets coating services to preserve metal products. The agriculture segment includes center pivot components and linear irrigation equipment, advanced technology solutions for the agricultural sector, mechanical irrigation equipment, and service parts under the Valley brand name. VALMONT Industries Inc.'s stock price has increased by 31.6% in the past year, with a year-to-date return of 32.84%. Several key factors have contributed to this surge. Strong third-quarter earnings and raised full-year guidance have driven investor optimism. The infrastructure segment saw significant growth, fueled by strong demand and favorable pricing strategies. Analyst upgrades and increased price targets further boosted confidence in the company's future performance. Consistent positive earnings surprises and a long-term dividend track record also contribute to the stock's upward momentum. Repeatedly reaching new 52-week highs underscores investor confidence and market momentum. These factors have collectively driven VALMONT Industries Inc.'s stock price increase over the past year. The primary drivers of revenue growth or decline can be identified through an analysis of the financial summary. Revenue growth is primarily driven by higher sales in the infrastructure segment, particularly in utility, telecommunications, and coatings product lines. These segments have experienced significant increases in sales, with some growing as high as 37% in the telecommunications sector. On the other hand, revenue decline can be attributed to lower sales in the agriculture segment, decreased revenue from contracts with short durations, and declines in specific product lines such as irrigation equipment and parts, solar, and lighting and transportation. The infrastructure segment's growth is a key factor in overall revenue growth, while the decline of the agriculture segment contributes to revenue decline. Geographically, North America has experienced lower irrigation equipment sales due to market softness, while international markets have been affected by project timing issues and lower volumes in South America. Net income and profit margins. A mixed picture. The financial summary reveals a mixed picture of net income and profit margins for VALMONT Industries, Inc. over the past year. On one hand, the company's net income increased by $18,482 from $82,610 to $101,092 in the 13 weeks ended September 27, 2025, compared to the same period in 2024. Additionally, operating income margin improved from 29.5% to 30.4% during this period. However, a different story emerges when looking at the 39 weeks ended September 27, 2025. Net income decreased by $87,725 from $272,189 to $184,464 compared to the same period in 2024. Operating income margin also declined from 13.5% to 12.7%. Furthermore, net earnings attributable to VALMONT Industries, Inc. decreased by 32.6%, and diluted earnings per share dropped by 41.5%. The reasons for these changes are varied but include impairment charges due to long-lived assets no longer being utilized, decrease in net earnings, increase in depreciation and amortization expenses, lower sales in North America within the agriculture segment, and higher impairment charges. These factors have contributed to a mixed performance in terms of net income and profit margins over the past year. The company is indeed generating positive operating cash flow. This is evident from multiple sources within the financial summary. On page 4, it is stated that the operating cash flow is positive, with a range of $978,414 to $1,336,265. Additionally, pages 5 and 34 confirm this trend, showing net cash flows from operating activities in both 2024 and 2025 as well as a significant positive figure on page 35. The company's confidence in future performance is also reflected in their belief that reporting units will generate positive cash flows going forward. The company's debt level and interest expenses have undergone significant changes. Notably, total liabilities increased by $35,578,000, indicating a rise in overall debt. However, long-term debt remained relatively stable. On the other hand, interest expenses have decreased substantially, with total interest expenses dropping by 98% and interest expense decreasing by 82%. This suggests that the company has made significant progress in reducing its interest burden. The company's financial performance varied across different segments and regions in the third quarter of 2024. The infrastructure segment stood out as a strong performer, with net sales increasing by 6.6% and gross profit rising by 7.2%. Within this segment, the utility product line saw significant growth, while the lighting and transportation product lines struggled. On the other hand, the agriculture segment experienced a decline in net sales of 9.2%, despite a slight increase in gross profit. The solar segment performed poorly, with a 50% decrease in sales. In terms of regions, North America saw sales decline by 11.3% in Q3 and 7.2% over 39 weeks. Telecommunications and coating segments were notable exceptions to the poor performance, with increases of 35.9% and 1.1%, respectively. International markets also struggled, particularly within the infrastructure segment. Overall, the company's financial results highlight areas for improvement in certain segments and regions. Management is optimistic about the company's outlook, expecting no significant impact from OBBBA on future periods. The company plans to allocate half of its operating cash flow towards high-return growth opportunities, such as strategic capacity expansion and acquisitions, while reserving the other half for shareholder returns through share repurchases and dividends. With a strong liquidity position, management is confident in the company's ability to meet its capital expenditure needs, estimated at $140–150 million for fiscal 2025. Overall, the company is focused on long-term growth prospects, with management committed to monitoring and adjusting estimates as circumstances evolve. The company has made several strategic moves through acquisitions and divestitures. Key acquisitions include the Delta plc acquisition in fiscal 2010, which aimed to enhance its competitive position. However, no specific details are provided about other acquisitions. On the divestiture side, the company has strategically exited the North American solar tracker market, sold related subsidiaries of net investment hedge activities, and disposed of George Industries, a coating and anodizing company in California. Additionally, it has divested its extractive business, which involved manufacturing and distribution of screening products for the mining and quarrying sectors in Australia and New Zealand. The company has demonstrated its commitment to returning value to shareholders through strategic share repurchases. Over the past year, significant investments have been made in buying back treasury shares, with notable transactions including a $125,839 expenditure on September 27, 2025, and a total of $181 million spent across multiple buyback initiatives. Concerns about inventory buildup and supply chain disruption are evident in our financial summary. Inventory buildup is a pressing issue, with raw materials and purchased parts inventory increasing by $39,506 on page 9. Furthermore, slow-moving inventory reserves were recognized at $6 million on page 28, indicating potential obsolescence issues. Additionally, inventory obsolescence was highlighted as a critical accounting estimate on page 34. Supply chain disruptions also pose a threat, with no relevant information provided on page 27 and decreased customer receipts due to large down payments received in the third quarter of fiscal 2024 on page 32. The decline in solar product line sales on page 28 is another indicator of supply chain issues resulting from strategic decisions to exit select regional markets. These concerns suggest that our company may be facing challenges in managing its inventory and supply chain, which could have long-term implications for our operations and profitability. That concludes the financial summary for VALMONT Industries INC. Feel free to comment below, and I will be happy to answer them when possible.